Traditional functions of banks. Collection of deposits. Banks collect two types of deposits from the public: demand deposits and term deposits. The balance in the savings bank and current accounts must be paid immediately on demand by the depositor. They are therefore known as demand deposits. On the other hand, the balances in a fixed deposit or a recurring deposit are paid only on the maturity date. Granting loans and advances. Banks have to pay interest on deposits, so they charge interest on loans to meet expenses and deposit interest. The difference in the interest rate on deposits and loans is called interest spread. Depending upon the period for which a loan is given, loans are divided into short-term and long-term loans. Cash credits and overdrafts are also called as advances. Depending upon the debtors, those who take loans are classified as personal loans, corporate loans, housing loans, etc. Loans that have security are known as secured loans, and those that do not have security are known as unsecured loans. Payments and remittances. Customers can pay the sellers through their bank accounts. Similarly, they can also transfer money to others. Demand drafts, checks, RTGS, NEFT are all methods used for the above purpose. 6. Other functions of banks. Obeying standing instructions of customers, paying LIC premiums, electricity bills, house taxes, collecting dividend warrants, etc. Collection of bills, checks from other centers for the customers. Collecting taxes from public for the government. Providing safe deposit locker facilities. Taking articles or documents for safe custody. Trusteeship services for executing the will of the deceased person. Electronic banking services, e.g. ATMs, internet banking, credit cards, debit cards, mobile banking services, etc. 7. Recent changes in banking sector. Banks can determine interest rates on deposits/loans without prior approval of RBI. Banks can give all types of services and facilities to customers. Universal banking. Financial inclusion by opening the accounts of all persons who do not have any part in the financial markets. Utilization of technology for upgrading several services, NEFT, RTGS, core banking facilities. Chapter 2. Relationship between banker and customer. 9. Contract definition. A contract is an agreement which is enforceable by law. Two persons or more can enter into a contract. There must be consideration for both the parties. E.g., for the seller is consideration, for the buyer the goods are consideration. For the banker interest is consideration, while for the borrower loan is the consideration. All transactions between banks and their customers are contracts. 10. Customer definition. The word customer is defined in the Prevention of Money Laundering Act 2005. A person becomes a customer as soon as he opens an account with the bank. It must be either a deposit or a loan account and relate to his business. A person who gets cash by presenting a check, a person who pays money and takes a DD, or a person who has only a locker is not a customer. Customer may be an individual, a company, a partnership, a trust, a society, a club, a government department. 11. Different types of accounts/customers. Accounts of individuals. By opening an account, the individual and the bank enter into a contract. Therefore, only a person above 18 years of age and a person of sound mind can open an account. Joint accounts. A joint account can be opened by two or more persons. All account holders must jointly authorize one person among them to sign and operate the account. Who must be paid the balance at the end? Based on this question, the following types of accounts can be opened. Either or survivor, as long as both are living, any one of them can sign and operate the account. When one of the persons dies, the survivor can operate the account. Former or survivor, as long as both are alive, the former, first named person can operate the account. After the death of the first named person, only the survivor can operate the account. Both jointly or survivor, under this method, as long as both are alive, both must sign and operate the account. After the death of one of them, the other person gets authority to operate the account. Illiterate persons. They can open accounts, but checkbooks will not be issued to them. The left-hand thumb impression of the illiterate person can be taken instead. of his signature. But this must be witnessed by another person. Accounts of minors. Persons below the age of 18 years are called as minors. They cannot legally enter into a contract, nor can they open an account with a bank. However, banks permit them to open accounts to teach them the saving habit. The account in the name of the minor must be operated by the mother or father of the minor person. These accounts can be opened in two formats as follows. A. K. Shiva, minor, by K. Narayana, father and natural guardian. B. K. Narayana and Master K. Shiva, E or S, operated by father. In case of children who have completed the age of 10 years, accounts may be opened in their individual names provided they understand the transaction well. However, ATM cards or checkbooks will not be issued to them, and overdrafts will never be allowed in their accounts. Minor can operate the account on his own after the age of 18 years. If the minor dies before attaining majority, the amount in the account will be given to his parents. Blind persons. Blind persons can legally enter into a contract. However, banks take the following precautions. The risks in operating an account must be explained to them. Joint accounts will be opened with close relatives. All payments will be made in the presence of witnesses. In all records it will be mentioned that the person is blind. Proprietorship concerns. Proprietor means owner of an enterprise. As an individual, the entire capital and profits belong to him. There is no need for any registration except under the Shops and Establishments Act. The firm is recognized in the individual name of the proprietor. There is no separate legal existence for the firm. If the proprietor dies, the enterprise also gets closed. Partnership firms. Partnership firms are constituted under the Partnership Act. Its features are: there must be a minimum of 2 partners and a maximum of 20 partners. For any type of business other than banking. In case of banking business, the maximum number of partners is 10. Profits and losses will have to be shared in accordance with the partnership agreement. Partnership agreement may be written or oral. Even if there is a written partnership agreement, it is not compulsory that it must be registered. Precautions while opening partnership accounts. The accounts must be opened in the name of the firm only. All the partners must sign on the account opening forms. They can delegate the authority to operate the account to one or more partners. Banks take a letter known as partnership letter signed by all partners at the time of opening the account with the following details: the name of the firm, the names and addresses of all the partners, the name of the partner who will operate the account, an agreement by all partners that they will be jointly and severally liable for any debt due to the bank, etc. The authorized signatory should indicate that he is signing for and on behalf of the firm on all checks and documents. If any one of the partners dies in a loan account, all operations in the account must be stopped. Similarly, if the guarantor who gave the security dies, also all operations in the account must be stopped. Limited Liability Partnership LLP. Limited liability partnerships combine both the features of partnerships and companies. They came into existence after the Parliamentary Act of 2008. Unlike the partnerships, LLPs have an identity separate from that of the partners. There must be at least 2 partners, and there is no upper limit for the number of partners. Unlike the partnerships, LLP will not cease to exist if one partner dies. LLPs will continue to exist even if all the partners die, because their legal heirs become partners automatically. Like the companies, LLPs can be closed only by the order of the High Court or through insolvency proceedings.